Hello everyone, this is Nitish and we have started an initiative called Plum series which is Prelims Level Up MCQ series. Here we discuss 5 MCQs daily and this will help you in your UPSC preparation. Today is episode number 46 and I am dealing with economics MCQs. Before starting this class, I would like you to please subscribe the channel and also like and comment on videos. These contents are free of cost, so for test series and foundation videos, you can contact to Vysh sir on WhatsApp 7200 681 675. So let's begin. Today's MCQ number 1 is the credit default swap is a financial derivative most closely associated with which of the following. Statement number A is securing a price hedge against variation in commodity prices, mitigation of risk associated with volatility in currency market, mitigation of risk associated with a fixed or a floating interest rate regime, and statement number D is insurance against possible non-repayment of principal or interest. I will give you 10 seconds. Try to answer this question. So its answer will be D, that is insurance against possible non-repayment of principal or interest. So before answering this question, you should be aware about what is credit default swap. Otherwise, you cannot able to answer this question. So let's look at the explanation. Credit default swap is an instrument of risk management in which an investor swaps or offset his credit risk with that of another investor. So now let's understand this concept with the help of an example that suppose person A has invested in a corporate bond, but he is not certain that a borrower is going to pay the interest or the principal amount on time. So to hedge his risk, person A approaches person B who agrees to reimburse person A in case of borrower default on his payment. In return, person A agrees to pay person B monthly premium till a certain maturity date. Person A and person B are said to be in credit default swap contract, and that is the credit default swap concept is. And that's why the answer is D, insurance against possible non-repayment of principal and interest. Now move on to MCQ number 2, that is which of the following are the possible signs of liquidity trap. Statement number 1, rise in unemployment, high saving rate, low interest rate, high investment rate. Options are 1, 2 and 3 only, 2, 3 and 4 only, 1, 3 and 4 only, and all of the above, that is 1, 2, 3 and 4. I will give you 10 seconds. Try to answer this question and write it in the comment section. So its answer will be A option, that is 1, 2 and 3, and statement number 4 is not the possible sign of liquidity trap. So before going into the statements, first of all we should know what is liquidity trap. Liquidity trap is a situation when expansionary monetary policy, that is increase in money supply, I am talking about, when expansionary monetary policy does not increase the interest rate, income, and hence does not stimulate economic growth, then such a situation is known as liquidity trap. Now move on to statements. Option number 1 is correct because during a liquidity trap, consumer avoid making new purchases as they expect the economy to deteriorate. This results in slowing of investment and economic activities, leading to fall in hiring and ultimately rise in unemployment. That is statement number 1, rise in unemployment. Now, statement number 2 is also correct because during a liquidity trap, people prefer to hold on to liquid asset like cash rather than invest in high return yielding instrument like bonds. So, the saving rate is very high. This may also be termed as infinitely elastic speculative demand of money. People prefer cash to bond. That is statement number 2, high saving rates. Now, look into statement number 3. It is also correct. Liquidity trap occurs during expansionary phase of monetary policy, as I already explained in the concept of liquidity trap. When the rate of interest is very low and the opportunity cost of holding money as cash is very low. At such times, further reduction of interest rate does not spur economic activity unlike normal times, thus monetary policy becomes ineffective. That's why the statement number 3 is also correct. Here we are talking about low interest rate. Now statement number 4, which is incorrect. A liquidity trap is when monetary policy becomes ineffective due to very low interest rate combined with consumers who prefer to save rather than invest in higher yielding bonds or other investment. People prefer to save money as cash rather than invest it or spend it. So economic activity and investment dwindles, leading to low investment rate. That's why the option number 4 is incorrect, because here high investment rate is given, which is basically low investment rate will be the correct statement, not high investment rate. Now move on to MCQ number 3. Recently, it is basically a current affair question. The International Labour Organization has released Global Employment Trend for Youth 2022 report. Which of the following is or are the reports of ILO, which means International Labour Organization, which means that you have to identify the reports released by ILO. Number 1 is Social Dialogue Report. Number 2 is World Employment and Social Outlook Report. Number 3 is Global Wage Report. Options are 1 only, 2 only, 1, 2 and 3, and none of these. I will give you 10 seconds. Try to answer this question. So the answer will be option number C, that is 1, 2 and 3, which means that all these reports are released by International Labour Organization. In this question there is no explanation because everything is mentioned in question itself. That is, you have to know which reports are released by International Labour Organization. From the question you can learn the 4 reports which are released by International Labour Organization. First one is the Global Employment Trends for Youth 2022 report, and the rest 3 statements, which means that the statement 1, 2 and 3, that is Social Dialogue Report, World Employment and Social Outlook Report and Global Wage Report. All these reports are released by International Labour Organization. Now move on to MCQ number 4. Which one of the following statements regarding banking ombudsman in India is incorrect? Here you have to identify the incorrect statement. So the statement number A is, it is a quasi-judicial authority formed with an intent to resolve the complaints of customer of the bank. Banking ombudsman members are appointed by Reserve Bank of India. The jurisdiction of banking ombudsman is limited only to scheduled commercial banks in India. And last statement is, any complaint can be rejected by the ombudsman on the ground of being previous. So try to answer this question and write it in the comment section. I will give you 10 seconds. So the answer will be C, which means that statement C is the incorrect answer. The jurisdiction of banking ombudsman is limited only to scheduled commercial banks in India. Now let's look at the explanation. Statement number A is correct because banking ombudsman is a quasi-judicial authority. It is formed with an intent to resolve the complaints of customer of the bank. And in the statement itself, in the explanation itself, few static part is also given. That is section 35A of the Banking Regulation Act 1949 deals with banking ombudsman scheme. It came into effect in 1995 and presently the Banking Ombudsman Scheme 2006 is in operation. So here you can look at the statement number A, which is the correct statement. Now, statement number B is also correct because under the Banking Ombudsman Scheme 2006, Reserve Bank of India appoints one or more of its officers in the rank of Chief General Manager or General Manager to be known as Banking Ombudsman to carry out the functions entrusted to them by or under the scheme. That is the statement number B. Banking Ombudsman members are appointed by Reserve Bank of India. That's why statement number B is also correct. Now, look at the statement number C, which is incorrect. Banking Ombudsman Scheme covers not just scheduled commercial banks but also regional rural banks and scheduled primary cooperative banks. And in the statement number C, it is mentioned that it is limited only to scheduled commercial bank. That's why the statement number C is incorrect. Statement number D is correct because any complaint can be presented by ombudsman on the ground of being previous, which is the statement number 4. Now, move on to MCQ number 5. With reference to monetary policy in India, which one of the following statement is incorrect regarding bank rates? So here you have to identify the incorrect statement, and this question is basically taken from your PYQ. Statement number A is it is the rate or the discount at which RBI grants loan or advances to commercial bank. An increase in bank rate directly affects the lending rate offered to the customer by the banks. Bank can avail funds at bank rate using either government security or cash as a collateral. And the last statement is the bank rate caters to long-term financial requirement of commercial bank. So here you have to identify the incorrect statement. So try to answer this question and write in the comment section. I will provide you 10 seconds. So the answer will be C, which means that statement number C is the incorrect statement regarding bank rate. Now let's look at the explanation. Statement number A is correct because bank rate is the rate or the discount at which RBI grants loan or advances to commercial bank. Hence it is also called discount rate. The money that commercial banks repay to RBI is the interest amount on the loans. And in the statement A we can see that it is the rate or the discount at which RBI grants loan or advances to commercial bank. So the statement number A is correct. Now, statement number B is also correct because bank rate directly affects the rate of interest of commercial banks loan. Commercial banks eventually charge their customers when there is an increase in the bank rate. It is to compensate for the higher interest they pay to the RBI. So, statement number B is also correct because any increase in bank rate directly affects the lending rate offered to the customer by the bank, as I already explained in the explanation part. Statement number C is incorrect. Bank rate do not require any kind of collateral, which means that there is also no selling or repurchase of eligible securities. Loans given at marginal standing facility rates involve providing government security as collateral. So, in bank rate, there is no need of cash or collateral. That's why the statement number C is incorrect. Last statement, that is statement number D, is also correct because the bank rate is meant for a long-term rate change and economic impact. RBI decides the bank rate as per the monetary policy of the country. That's why the statement number D is also correct. I hope you like this session. So the next episode will be tomorrow. So please subscribe and stay tuned. Thank you.